Between 2018 and 2020, the United States government launched the most aggressive trade confrontation with China in modern history. Tariffs on hundreds of billions in Chinese imports. Political rhetoric about reshoring American manufacturing. Both parties unified in messaging about finally standing firm against Beijing's economic expansion. The entire political establishment broadcasting the same narrative: America was drawing a line. And during those exact same years, while the headlines screamed about economic warfare, BlackRock, JP Morgan, Goldman Sachs, and the rest of Wall Street quietly redirected $1.4 trillion into Chinese markets. Not million, not billion, 1.4 trillion with a T. Peak year? 2020. The absolute zenith of trade war tensions. You might assume this was miscalculation. Perhaps Wall Street misread the political climate. Maybe these institutions got caught on the wrong side of geopolitical realignment. That assumption would be completely wrong. This was the most telegraphed financial repositioning in modern history, because what looks like contradiction is actually mechanism, a mechanism that has repeated itself for over 3 centuries with mathematical precision. Once you understand this pattern, the entire narrative of American economic decline snaps into focus. And the uncomfortable reality becomes undeniable. We're currently in stage 3 of a 4-stage cycle that has destroyed every reserve currency system in recorded history. The same cycle, the same sequence, the same outcome. Let me show you how this machine works. Because it's not random. It's not accident. It's a systematic transfer of wealth and power that executes with mechanical reliability, regardless of which empire thinks they've figured out how to make it permanent this time. The pattern has 4 distinct stages. Stage 1. Financial elites establish monopoly control over money creation through a central banking system. Stage 2. This monopoly finances government expansion through debt monetization, economic boom, empire building, everyone convinced they've discovered sustainable prosperity. Stage 3. The system overextends. Currency begins losing purchasing power. Cracks become visible. Government loses control of the narrative. Stage 4. The exact same institutions that built the system relocate their capital to the next rising power before the collapse becomes obvious to the general population. The public gets left holding devaluing paper. We've watched this execute in Britain, in Germany, in post-Bretton Woods America, and it's executing again right now as Wall Street floods into China, while Washington performs theatrical opposition. Let me walk you through the historical precedent so you understand this isn't speculation. This is documented pattern recognition. Britain, 1694. The kingdom is at war with France and bleeding money. William Paterson proposes an elegant solution: create the Bank of England. The arrangement? The bank extends £1.2 million to the government at 8% interest. But the real innovation isn't the loan amount. It's the mechanism. Government creates debt. The bank converts that debt into circulating currency. And the wealthy subscribers to the bank collect interest on the nation's entire money supply. Stage 1 complete. Within 4 years, Britain's national debt explodes from £1.2 million to £16 million. By 1815, after financing the Napoleonic Wars through continuous monetary expansion backed by government obligations, debt reaches £885 million. The lenders didn't merely profit. They owned the British government's financing mechanism. Stage 2 executes perfectly. Britain constructs the world's dominant navy, colonizes half the planet. The pound sterling becomes the global reserve currency. International commerce settles in British pounds. Foreign governments hold pounds as reserves. The system appears unstoppable. Britain dominates global finance. But by the mid-1800s, the foundation starts cracking. British industrial output peaks and begins declining relative to Germany and America. The cost of maintaining global empire grows faster than revenue can support. Debt accumulates again, and this is where the pattern becomes fascinating. The same financial institutions that constructed the British system begin relocating their capital to America. British money pours into American railroads, American steel production, American industrial expansion. The Rothschilds finance American development. By the time Britain officially abandons the gold standard in 1931, by the time the pound collapses as reserve currency, the architects have already reconstructed the identical system in New York. They moved the capital before the collapse. Stage 4, executed flawlessly. Second example, Germany, after World War I. The Treaty of Versailles imposes 132 billion gold marks in reparations, crushing debt owed to Allied powers. The Weimar government faces a choice: raise taxes to service the debt or print currency. They choose the printing press. The Reichsbank, Germany's central bank, begins monetizing government obligations, paying striking workers, funding social programs, maintaining political stability. When France and Belgium occupied the Ruhr industrial region in January 1923 to physically seize resources as payment, Germany responds by paying Ruhr workers to strike, paying them with printed currency. The monetary expansion becomes catastrophic. May 1923, 8.6 billion marks in circulation. June, 17 billion. August, 669 billion. November, 400 quintillion. By November 1923, $1 purchases 4.2 trillion German marks. A wheelbarrow full of currency won't buy a loaf of bread. Workers receive payment hourly because their morning wages become worthless by afternoon. Prices increase during business hours. The middle class evaporates, life savings disappear overnight. And here's what standard history omits. This wasn't accidental policy failure. Rudolf Havenstein, the Reichsbank president, deliberately purchased foreign currency with marks regardless of price or inflationary consequence. The government claimed this was necessary to meet reparation obligations. British and French economic advisors stated publicly it was intentional currency destruction. Later records confirmed their assessment. The hyperinflation served purposes. It eliminated domestic war debts. It destroyed the politically inconvenient middle class that might have resisted authoritarian consolidation. When the crisis peaked, when Germany introduced the Rentenmark in November 1923 to halt the collapse, the solution required American capital. The Dawes Plan of 1924 brought Wall Street into Germany to restructure everything. US money flooded German markets through the late 1920s. American banks and corporations gained massive exposure. Then, when that system collapsed in the early 1930s, creating conditions that enabled the Nazi rise to power, those same American financial institutions were already positioned for whatever came next. Same pattern, different century. Central bank monetizes government debt. System expands through inflation. Currency collapses. Foreign capital restructures during crisis. Then exits before political disaster completes. Third example, the one that created our current system. Bretton Woods, New Hampshire, 1944. Representatives from 44 nations establish a new monetary order. The US dollar gets pegged to gold at $35 per ounce. Every other currency pegs to the dollar. Foreign central banks can redeem their dollars for physical gold at that fixed rate. The dollar becomes global reserve currency backed by the world's largest gold reserves at Fort Knox. For 2 decades, it functions. Europe and Japan rebuild. The dollar circulates globally. American economic dominance appears total and permanent. But then the US begins using its ability to print the reserve currency to finance Vietnam. The Great Society programs. Cold War military buildup. All without raising taxes proportionally. The Federal Reserve expands money supply. Interest rates stay suppressed. The economy continues growing. Dollars flood into foreign central banks as America runs increasingly large trade deficits. By 1971, there are far more dollars circulating internationally than the US possesses gold to back them. France recognizes what's happening. Under Charles de Gaulle, they begin demanding gold for their dollar reserves. In August 1971, President Georges Pompidou sends a warship to New York to collect French gold. Switzerland exits the system on August 9th. On August 11th, Britain requests $3 billion in gold transferred from Fort Knox to New York. Paul Volcker, then Treasury Undersecretary, later stated that when Britain, the country that co-founded the system and fought to defend their own currency supremacy, started converting dollars to gold, everyone knew the arrangement was finished. By August 15th, only 10,000 metric tons of gold remained in U.S. reserves. August 15th, 1971. Sunday evening. Nixon appears on television and announces the U.S. is temporarily suspending dollar convertibility to gold. The gold window closes. That temporary measure remains in effect today. The Bretton Woods system collapsed. By March 1973, the world moved to floating exchange rates. The dollar became pure fiat currency, backed by nothing except government promise and U.S. military dominance of global oil markets. Since that day, the dollar has lost over 98% of its purchasing power against gold. In 1971, gold traded at $35 per ounce. Today, it exceeds 2,300. Same pattern. System overextension, loss of monetary discipline, currency debasement. Now let's apply this framework to what's happening in real time. July 6, 2018. Trump imposes the first tariffs on Chinese goods, $34 billion worth. The trade war officially begins. America's finally confronting China, rebalancing trade, bringing manufacturing home. Both parties supported, the political establishment unified in rhetoric. But July 6, 2018 is significant for another reason entirely. It's exactly 1 month after June 1st, 2018, the day MSCI, the company controlling global investment indices, officially began including Chinese A shares in its emerging markets index. Think about what this means structurally. When MSCI includes a market in its indices, institutional investors tracking those indices must allocate capital to that market. It's not optional. Pension funds, sovereign wealth funds, university endowments, insurance companies, trillions of dollars that mechanically follow index weightings. China's weight in the MSCI Emerging Markets Index went from essentially 0 to 43% by October 2020. During this identical period, 2018 through 2020, U.S. portfolio investment in China reached $1.4 trillion. Peak year, 2020. Trade war at maximum intensity. BlackRock expanded its Chinese operations throughout this entire period. JP Morgan received approval for a majority-owned securities business in China. Goldman Sachs increased its stake in its Chinese joint venture. Morgan Stanley applied for similar arrangements. These aren't coincidences. These aren't strategic errors. These are the same institutional structures that operated through Britain, through Germany, through post-war America, and they're executing stage 4 right now while everyone watches political theater. Let's verify the pattern components. U.S. national debt, $36 trillion. Debt to GDP ratio, 98%. The Federal Reserve's balance sheet was under $1 trillion in 2008. It exploded to $9 trillion during COVID, currently still above $7 trillion. Same mechanism as always. Central bank monetizes government debt. Government spends far beyond what taxation can cover. Currency supply expands way beyond the economy's productive capacity. And the financial institutions running this process begin relocating capital to the next power center. Stage 1. Federal Reserve established 1913. Monopoly on money creation achieved. Stage 2. Decades of debt monetization, financing wars and programs globally. Stage 3. System overextended with debt at 98% of GDP. Currency debasing through inflation. Stage 4. Financial institutions moving capital to China while Washington performs opposition theater. We are here, right now. In stage 4, the pattern doesn't care about your political preferences. It doesn't care whether you believe in American exceptionalism or technological salvation or modern monetary theory or any other intellectual framework designed to explain why this time is different. This time is not different. The mechanism is mathematical. When a monetary system operates on debt creation, when the entity creating money is separate from but dependent on the entity that taxes, when the system expands beyond productive capacity, the currency debases. And when the debasing currency is the global reserve currency, the architects of that system relocate their capital before the collapse completes. Here's what people miss entirely. The trade war was theater. It was designed to fail. Or more precisely, it was designed to appear as resistance, while actual financial integration accelerated behind the scenes. You cannot fight China with tariffs, while your largest financial institutions are moving record capital into Chinese markets. You cannot reshore manufacturing, while index providers controlling institutional capital allocation are increasing China's portfolio weight. You cannot maintain dollar hegemony while running trillion-dollar deficits financed by central bank money printing. The contradiction isn't mistake, it's the mechanism itself. The British population didn't understand in 1880 that their capital was building American industrial capacity. The German population didn't understand in 1929 that American banks had facilitated their hyperinflation cycle. The American population doesn't understand now that Wall Street is constructing China's financial infrastructure while Washington performs resistance for domestic consumption. But the pattern doesn't require your understanding to execute. It simply runs its course with mechanical precision. Consider the timeline more carefully. 2017. China announces plans to fully open its financial sector to foreign investment by 2020. Trump takes office promising to get tough on China. January 2018. Trump administration begins considering tariffs. March 2018. First tariffs announced on steel and aluminum. June 1st, 2018. MSCI begins including Chinese A shares in emerging markets index, forcing institutional capital flows. July 6, 2018. First China-specific tariffs implemented. And throughout this entire sequence, from 2018 through 2020, Wall Street executes the largest capital repositioning into China in history. This wasn't Wall Street betting against Trump's policy. This was Wall Street executing the next phase of a 300-year-old pattern, while political leadership provided theatrical cover. The trade war served multiple functions. It satisfied domestic political demand for China confrontation. It created negotiating leverage for specific corporate interests. And it distracted attention from the systematic financial integration occurring simultaneously. Look at what actually happened during the trade war. Did manufacturing return to America in meaningful scale? No. Did the trade deficit with China shrink significantly? No. Did American financial institutions reduce their exposure to Chinese markets? The opposite. They increased exposure by $1.4 trillion. What did change? China accelerated development of indigenous technology to reduce dependence on American components. China strengthened trade relationships with Europe and Asia to diversify away from US markets. China expanded use of yuan in international trade settlement. And China received $1.4 trillion in American institutional capital to fund this exact transition. The trade war didn't weaken China's position. It accelerated China's preparation for a post-dollar dominated system while American capital financed that preparation. This is stage 4 execution. The architects of the current system positioning for the next system, while the current system's government performs opposition. Now, consider what this means for the next 5 to 10 years. The pattern has never failed to complete once it reaches stage 4. Britain tried to maintain pound sterling dominance while their capital built America. It failed. The pound lost reserve status. Germany tried to maintain mark stability while American capital restructured their system. It failed catastrophically. America tried to maintain gold convertibility while financing global expansion through inflation. It failed. Nixon closed the gold window. The current system will not be different. The US cannot maintain dollar hegemony while running unsustainable deficits financed by money printing. Cannot maintain reserve currency status while the currency loses purchasing power through inflation. Cannot prevent capital from flowing to higher growth opportunities regardless of political rhetoric about strategic competition. The mechanism is already in motion. By the time this becomes obvious to mainstream understanding, the repositioning will be complete. The current system dollar as reserve currency, American financial dominance, the post-Bretton Woods order is not permanent. It's stage 3 of a 4-stage pattern, and stage 4 is executing while most people watch political theater and miss the systematic wealth transfer occurring beneath it. So, what do you do with this information? First, you understand that holding assets denominated purely in a debasing currency is a choice to participate in the transfer mechanism. You're voluntarily positioning on the wrong side of a historical pattern. Second, you understand that the inflation isn't temporary, isn't transitory, isn't the result of supply chain disruptions. It's the predictable outcome of monetary expansion disconnected from productive growth. Third, you understand that when they tell you not to worry, that this time is different, that modern financial engineering has solved the problems that destroyed previous systems, they are either ignorant of the pattern or complicit in its execution. And fourth, you understand that the next 5 to 10 years will not resemble the last 30. The mechanism is accelerating. The debt cannot be repaid. The currency will continue debasing. The financial elite are already positioned. The only question is whether you understand the pattern clearly enough to recognize it happening in real time and make decisions that account for the inevitable outcome. This is not prediction, this is pattern recognition. The same mechanism that moved British capital to America in the 19th century, the same mechanism that moved American capital into Weimar Germany before collapse, the same mechanism that moved capital out of the US as Bretton Woods failed, is moving capital into China right now. While politicians debate tariffs, while think tanks discuss decoupling strategies, while media obsesses over trade war optics, Wall Street has already decided. 1.4 trillion has already moved. And the pattern, which has never failed to complete itself across 3 centuries, is 3/4 through its execution. You are watching stage 4 of a currency collapse happen in real time, not suddenly, not dramatically, but systematically and mechanically, exactly as the pattern dictates. The population will hold the currency as it approaches worthlessness. The architects of the system will have already relocated their wealth to the next power center. That is the pattern. That is the mechanism. And that is what is happening right now while everyone watches political theater and misses the systematic wealth transfer occurring behind it. The machine is running. The pattern is executing. And unlike every previous iteration, this time you have the opportunity to see it while it's still in progress, rather than understanding it only after the collapse is complete. The question is whether you'll recognize what you're seeing and position accordingly, or whether you'll trust the official narrative and end up on the wrong side of history's most reliable financial pattern.